Welcome back to Algobot, the channel where we take apart automated trading strategies and study how they actually think. I'm Algobot, your guide for today, and we're examining an expert advisor for MetaTrader 5 called the Inverted Gap Limit Continuation. This is a pure price action system. It uses no traditional indicators at all, only the raw geometry of the candles themselves. Over the next several minutes, you'll learn what a fair value gap is, what it means for one to invert, and how this strategy rests a patient limit order to join a fresh break of market structure. Remember, everything here is educational information only. Let's start with the big picture. The inverted gap limit continuation is what traders call a smart money or price action approach. There are no moving averages, no oscillators, and no momentum lines anywhere in this code. Every level, every filter, every stop, and every target is derived purely from candle geometry. The only average it computes is a plain mean candle range, used simply to measure how large the market's candles are right now, so the gap filter can scale to current volatility. At the heart of the strategy is the fair value gap. A fair value gap is a three-candle imbalance, where a fast middle candle leaves behind a small untraded void on the chart. Most price action methods treat that void as support or resistance that holds. This strategy does the opposite. It waits for the void to fail. When a bar closes cleanly through a fresh gap, and that very same close also breaks the most recent fractal swing point, the imbalance is considered invalidated, and it inverts. A broken bullish gap is treated as fresh supply, and a broken bearish gap is treated as fresh demand. Once a gap inverts, the strategy does not chase price with a market order. Instead, it parks a passive limit order at a tunable depth inside the inverted void and lets price come back to it. Risk is defined structurally, just beyond the far edge of the void. The target is a fixed multiple of that risk, and once a position runs far enough in its favor, the stop is pulled to break even. This educational example was tuned with foreign exchange majors, gold, and stock indices in mind, on time frames from 5 minutes up to 1 hour, though the logic itself is locked to no single time frame. It will appeal to viewers who want to understand structure-based, patient, limit order entries rather than indicator crossovers. One more thing worth noting up front. The strategy is deliberately disciplined, managing only a single resting order or open position at any moment, so there is no stacking of trades. As always, trading involves risk, and losses are a normal and expected part of any approach. Nothing here is financial advice. Let's walk through the engine step by step. The strategy works on closed bars only, acting once each time a new primary time frame candle completes. First, it measures volatility. It sums the high-to-low range of the most recent candles, set by the range lookback parameter, and divides to get an average range. The minimum gap factor is then multiplied by that average to produce a minimum gap size. This ensures the strategy only pays attention to gaps that are meaningfully large relative to current conditions. Second, it tracks structure using fractal swings. A bar becomes a confirmed swing high or swing low when its high or low dominates the bars on each side of it, with the number of bars controlled by the SwingStrength parameter. These confirmed swings are the reference points for a genuine break of structure. Third, it scans the last 3 closed candles for a fresh fair value gap. For a bullish gap, the high of the oldest candle must sit below the low of the newest, with a bullish middle candle, and the void must be at least the minimum gap size. A bearish gap is the mirror image. Each qualifying gap is stored with a creation timestamp. Fourth, and this is the key idea, the strategy checks whether any stored gap has just inverted. A bullish gap inverts only when the latest close is below the void and also below the last swing low. A bearish gap inverts only when the latest close is above the void and above the last swing high. That double condition ties every inversion to a real break of structure, not just a single candle poking through. Fifth, when a gap inverts, the strategy arms a passive limit order inside the inverted void. The entry depth parameter decides how deep into the void the order sits, from the first touch to the deepest edge. A broken bullish gap becomes supply, so it rests a sell limit. A broken bearish gap becomes demand, so it rests a buy limit. Sixth, risk and reward are defined. The stop is placed beyond the far edge of the void, padded by the stop buffer percentage. The take profit is the entry price plus or minus the risk-reward multiple of that measured risk. Once price runs in favor by the break-even-R amount, the stop is moved to the entry price. Finally, housekeeping keeps things clean. Gaps that never invert are dropped after the FVG expiry. A resting limit is canceled if price reclaims the void or after the limit expiry passes. And the strategy only ever manages one order or one position at a time. Let's read the meta-editor code together. At the top are the input parameters, the dials you can adjust in the strategy tester. Minimum gap factor sets how large a gap must be as a fraction of the average candle range, so a higher value ignores small gaps. Range lookback controls how many bars feed that average. SwingStrength defines how many bars on each side confirm a fractal pivot, where a larger number means rarer but firmer structure points. Entry depth decides how far inside the inverted void the limit order rests. Stop buffer percentage pads the stop beyond the void. Risk-reward fixes the target as a multiple of risk, and break-even-R sets how far price must travel before the stop moves to entry. The two expiry inputs simply age out stale gaps and unfilled orders. Now the signal logic. The code loops through stored gaps, and for a bullish gap, it applies the inversion test you see here. It reads the last close bar's close price and checks two things at once. First, that close must be below the gap's lower edge, meaning price has traded clean through the void. Second, a confirmed swing low must exist, and that same close must be below it, confirming a break of structure. Only when both are true does the gap invert into supply. When that happens, the strategy computes the order. Entry is the void's lower edge plus the entry depth fraction of its height. The stop sits above the void plus the buffer. Risk is the distance between them, and the take profit is the entry minus the risk-reward multiple of that risk. Finally, it places a sell limit. The buy side is simply the mirror image of everything you just saw. Let's watch this play out on the chart, following both a long and a short example in sequence. On the left, price slides lower and leaves behind a small three-candle imbalance, a bearish fair value gap. Then a strong bullish candle pushes up and closes cleanly above that void, while also closing above the recent swing high. That double break inverts the gap. What was a bearish gap is now treated as fresh demand, the green band you can see on the chart. The strategy does not chase the move. Instead, it rests a buy limit at a measured depth inside that green void. A couple of candles later, price retraces gently back down and touches the level, and the buy limit fills around 1.0863. From there, price lifts away to the upside and reaches the fixed reward to risk take profit near 1.089. That completes the long example. Now watch the upper portion of the chart for the short. As price rallies, it prints a fresh bullish fair value gap, leaving the red band marked as a potential inverted supply void. Price then turns and a firm bearish candle closes below that void and below the most recent swing low, breaking structure to the downside. The bullish gap inverts into supply. The strategy rests a sell limit inside the red void, and as price drifts back up to retest it, the order fills near 1.0884. Price then rolls over and slides down to its take profit. Notice the pattern in both cases. The strategy waits for a failed gap and a confirmed break of structure, then lets price return to a defined level rather than entering at the extreme. This is an illustration of the logic, not a prediction of results. And that brings us to the end of our breakdown of the inverted gap limit continuation expert advisor. We covered how it measures volatility, how it tracks market structure with fractal swings, how it detects and then inverts a fair value gap on a genuine break of structure, and how it rests a patient limit order with a structural stop, a fixed reward to risk target, and a break-even trail. Everything we discussed today is educational content only, intended to help you understand how an automated strategy is built and reasons. It is not financial advice, not a recommendation, and not a solicitation to trade. If you found this useful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like us to study next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.